The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thank you for taking the time today to join the Krasny Financial webinar covering the investment implications of the U.S. elections. Today's webinar will be conducted by Steve Tuttle, the firm's Chief Investment Officer. My name is Ben Waldman, and I will serve as the moderator. With the U.S. election only 1 month away, many investors increasingly have questions about the potential effects the election results will have on the investment environment. Steve will offer some perspective and insight into key factors investors should be aware of during this election season. This is not intended to be political discussion, but rather to allow for insight, again, into what the elections may mean for the investment environment. Without further delay, I'm going to turn the microphone over to Steve Tuttle.
Thank you, Ben, and thank you all for joining us today. As Ben mentioned, we're going to cover specifically the implications of an election year, what markets have historically done, are there any unique characteristics of the elections that we're facing right now? And I think the answer to that is undoubtedly yes. We're in the midst of a very polarized and maybe entertaining is the right word, U.S. election campaign. And I think it's important to remind everyone that this is a good time to be a media company. Ratings are at all-time highs. It's a good time to be a comedian. Saturday Night Live is probably doing pretty well. The late night talk show is doing very well. But I do just want to remind you that news media and newspapers are primarily designed to attract viewers and to entertain. They're not necessarily there to provide advice, nor are they there to inform any longer, unfortunately. In fact, I'm going to quote the CEO of CBS, Les Moonves, who said earlier in this year about the elections, "It may not be good for America, but it's damn good for CBS," is what he described the presidential race for. So that being said, I'm going to try to inform and provide some guidance and some perspective on how we as investors should look at and feel about the elections. So quick summary is I think it's real important that to recognize that the impact of the election is very likely to be more muted than all the campaign hype suggests. And if you look back at history, sure, markets tend to favor the incumbents. That's what a lot of the data says, particularly in the months leading up to presidential elections. A lot of that has to do with uncertainty. Talking about a new president or a new political party, markets may get a little cautious, a little uncertain, a little risk averse. However, politics aside, who our president is has proven to be a little less important in terms of market performance over longer periods of time, and I'll show some data that supports that. And I'll end this quick summary by saying, regardless of who wins the election, I think it's important to stick to your plan, to not get shaken out of your long-term goals. Markets in general are doing fairly well. I think it's important to continue to capitalize on the ongoing expansion and improvement that we've been seeing in the global economy, and at the same time be aware of that at some point in the future, perhaps in the near future, there's going to be a pullback. There's going to be some uncertainty. So to have a disciplined approach and be prepared for the next downturn is always important. So let's talk a little bit about what we're all facing as investors, and to me, a lot of it comes down to allocation decisions. Do we own enough stocks? Do we own too many stocks? Do we own bonds? Do we own cash and safe assets? What's that appropriate allocation given the uncertainty that as I mentioned, is all over the media right now? And there's a lot of challenges that the next presidential candidate and party have to face. We're in a very polarized political environment. Growth globally is not great. Interest rates seem pegged at a very low level, and there's geopolitical risk throughout the world. So can the next president boost growth, improve trade, continue to innovate and create jobs? That's the key question, and that's the challenge that we're faced with as voters. The other thing that I think is very interesting about this election, and this really hit home for me in what happened over in England just a few months ago with the Brexit vote. So ever since the big recession that we saw in 2008, the economy has been pretty lackluster. There's been some growth, but it's been very tame. And as a country, it sure seems like the mood of the public is very sour, very distrustful of politicians and big institutions, financials, etc. A lot of that has to do with the pace of recovery has been very slow. Income growth has been anemic. All right, and at the same time, there's been structural changes in the U.S. economy as more and more our country is becoming a service economy. Manufacturing jobs are shrinking. Technology, while we as consumers have benefited from it, it's also created some challenges in certain sectors of the workforce. And increasingly, the economy is not local to the U.S., it's global. So we're facing more and more competition from around the world. And so what I think has happened as a result of this is there's a lot of people that maybe they're angry. Maybe they are, they want change, and they want important change. And you saw it over in England in the Brexit vote, which surprised many. And I think you're seeing it in our economy, in our political environment right now, with the candidates that are garnering a lot of attention are definitely singing the same tune in terms of populism. All right, so let's talk a little bit about what the numbers show in terms of elections. But before I go into that, I want to caution everybody to be wary of statistics somewhat. It's very natural for us as humans to look for patterns. That's what we want to do. That's our nature. But when it comes to historical market returns in politics, the link is not as simple, and perhaps the patterns that appear to be there may not be as relevant as we think. A lot of it has to do with how the data gets sliced. And I personally believe, and this is based on some research that we've done in-house and also other academic research that we believe is credible, that the impact on elections may be less than you think, and the impact on the economy is probably not quite as important as to who the political party is in charge, and more it's a function of the timing and the impact of major world events, where interest rates are, et cetera, et cetera. And moreover, I believe that it's actually that economic data that impacts the popularity of a particular president or political party. And so it's an interesting debate, certainly, but I do want to point that out before I go into some of the numbers. All right, so here's some interesting pieces of information about election years. Historically, the S&P 500 has been up in election years. We're up so far this year, so that's consistent with history. I think it's very interesting to point out how in many parts of the country, it doesn't matter who the candidate is, they're going to vote one way or the other. In fact, 31 states have voted for the same party in the past 6 elections. So that's a pretty long period of time where the vote has gone the same way in those states. Turnout, very important in elections. And in our country, in our country, as in many others, like in England during the Brexit vote, the turnout is not great. In fact, during the 2012 presidential election, less than 60% of eligible voters actually voted. The other thing that I think is an emerging trend that we'll see increasingly play a bigger role is millennials. The younger generation is now the largest U.S. population group and soon to be the largest voting bloc. So that's something that could play out over the next several decades in terms of changes in our political environment. So if you look at the presidential elections, and I referenced in the beginning how the incumbent party tends to win if the economy or the stock market is doing well that year, and tends to lose if the stock market's not doing well. So in that regard, perhaps the stock market is a predictor of who's going to win the race, and this chart just highlights that. Okay, another summary statistic about election years, but so in the short term, U.S. equities generally rise in the 3 months following presidential elections, and again, this is regardless of who wins. They tend to go up. However, the first month after the elections are a little bit more volatile and inconsistent. So you could very well see this year that uncertainty begin to kick in as we approach the election, and then it may continue for a period of time afterwards, but then generally markets stabilize and resume the trend that they were already under. So here, this is a slide that is an indicator that Goldman Sachs put together, and it's essentially their attempt to quantify uncertainty. And what it shows is that as you approach election day, uncertainty increases, and then as the election takes place, the tension eases. And it certainly seems like we're on that path this year. The other thing I'll say about the actual policies that are being debated in the media and also in the debates and Twitter feeds and social media, I'll remind everyone that the policy platforms that are being promoted out there right now, you have to discount not just what the parties are saying, but is it likely that they're going to be able to actually implement their plans? And what we found is that quite often the headline risk of these policies may be far less impactful on the stock markets in the long term, because not everything and perhaps not the majority of what is discussed right now in the campaign actually gets implemented. All right, so the key point here is that the headline risk may be much more overstated than the real risk of policy change. And some of that, the reason behind that is because of our political system that we have in place. So many of you may have heard, a pretty famous quote from Winston Churchill that says, "Democracy is the worst form of government except for all the others." So I think that really hits home today that sure there's some frustration out there among voters, and our system certainly has some shortcomings, but these same shortcomings may also be the strength of our government. All right, separations of powers and checks and balances tend to work pretty effectively. And Congress, in particular, has often proven to be a very useful buffer between a president's aspirations and actual policy that impacts the economy. So if we want to get a little bit more specific about certain areas of the stock market that may be impacted by the election topics this year, there's an area of the economy where it certainly seems the market has made up its mind and has created some certainty there. And in that regard, both candidates have views that should benefit more government spending. All right? So sectors, companies, and industries that have a significant portion of their revenue that comes from government exposure are likely to do well. And specifically, that tends to be in the industrial and material sectors, higher infrastructure spending. Both candidates are talking much about that. Also in defense, there seems to be a common theme that more money and spending is going to go into that sector. So can we capitalize on that? Can we take advantage of that? To some extent, maybe yes. However, if you look at the actual performance of those stocks in those sectors, they've already moved quite a bit this year. So to that extent, the expectation of higher government spending has already been priced into the marketplace. Right? In other areas, there's more of a difference between the two candidates, and Clinton and Trump seem to have different views, and therefore sectors like healthcare, energy, and financial services are much more likely to react differently to their policies. All right. I'll also highlight companies that have high tax rates or low tax rates, or high domestic sales versus foreign sales, and even companies that would benefit from higher minimum wages, or companies that would be hurt by higher minimum wages. So those are several areas and sectors that you could see some differences based on who the market thinks is going to win. So on the financial services side, clearly more regulation seems to be a main point made by Secretary Clinton. And while that is not necessarily a good thing for financial stocks, and you've seen financials lag this year, again, that's pretty well priced into the marketplace right now, and financial stocks are pretty cheap on a valuation point of view, and perhaps with good reason. With more regulation and oversight, it might be harder for banks to increase their earnings. However, the other side of the financial sector is on the debt side. So if financial companies are not able to leverage their balance sheets as much and not able to invest their capital as aggressively, if you think about the bondholders of those financial stocks, those bonds in terms of credit quality is probably going to improve. They're going to become safer investments. It's going to be easier for banks to repay their debt because they're not leveraging their balance sheet as well. So there's two sides to that equation. On the stock side, perhaps financial stocks are going to struggle. They have struggled, and they're priced accordingly. But on the bond side, it certainly looks to us like bank bondholders should benefit and have been benefiting from higher regulation. On the healthcare side, there's a pretty big and pretty dramatic difference between the two policy groups. Healthcare has struggled a little bit this year in anticipation of some policy changes which could hurt drug companies in particular. In terms of minimum wage, I'll comment on that. That can be a good thing for certain sectors. Higher minimum wage may benefit consumer discretionary companies, as consumers have, if their wages go up, they may have more money to spend at the retailers. However, companies that, particularly like in the restaurant space, that will have to increase their employee costs and pay wages, that could hurt those types of companies. And then in terms of policies affecting tax rates, and both candidates have some interesting policies there. I would think that what we could expect is that there could continue to be an advantage to companies that have a higher proportion of their sales coming from right here in the U.S. and not as a bigger percentage of exporters. So here's just a couple slides that talk about, in terms of government infrastructure spending, it's pretty low on a relative basis. It's certainly down from where it was in the 90s, and so that it would make sense to see more government spending and infrastructure spending benefiting industrials and material companies. Similar dynamic when it comes to defense spending. Defense spending has been on the low, but both candidates are seem to be indicating that it's time to boost up our spending in that area. And here's another slide that sort of just highlights what we've talked about. Regardless who wins, there's certain areas of the economy that are leveraged to fiscal expansion, higher government spending, and we just highlighted those right now. Infrastructure and defense are the two that are most impacted, and both those sectors have done very well this year. Increased fiscal spending could also boost GDP growth. All right, so the economy perhaps would increase. How would that filter through to markets? Well, presumably with higher economic growth, interest rates will continue to increase. This could boost corporate earnings, and in both of those scenarios, that could benefit cyclical industries. But it could also hurt some of the more defensive names like utilities and consumer staples, which are benefiting from the very low interest rates and the flight to safety that we've seen over the last few years. So that could be, this could create a reversal of the dynamic that we've seen over the last 12 to 18 months, where utilities and defensive stocks have outperformed companies that have higher growth potential. The other thing that I think has been common from both candidates is the protectionism, and this could benefit U.S. small cap stocks or companies that have most of their sales coming from right here within the U.S. and they don't rely on exports. So what we could see potentially is the U.S. dollar continue to appreciate. That would be a function of a normal reaction to healthy U.S. growth and tighter Fed policy or raising rates. That could strengthen the dollar. Tax reform could make it more difficult for companies that have operations overseas in order to capture lower tax rates. It might make it more beneficial for companies to stay here in the U.S. borders. And then renegotiating trade deals, which has been a popular topic, that could negatively import companies that export a lot of their goods. All right. All of these trends of a more protectionist regime and policy could very well benefit U.S. companies that have, again, more of their sales coming from right here in the U.S. as opposed to international sales. In terms of federal minimum wage policies, Trump has endorsed increasing the minimum wage to around $10 an hour. Clinton a little bit more aggressive, up to $12 an hour. So both of them are suggesting higher minimum wages. And again, I highlighted it before. This is going to benefit certain areas of the economy and hurt others. With both candidates preaching that this is a policy that they want to implement, the impact of that has already been priced into the market. And so that's probably the recurring theme that I've been highlighting again and again is much of what is expected gets priced into the market immediately. And I think what we need to be wary of, and this is what we do spend some time on, is not necessarily what is already expected, which is what's on the cover of the magazine covers and on the front page of the newspapers. That's no way to manage an investment policy. What really drives markets are the unexpected events. And so in terms of potential surprises that we have our eyes on, so again, these are these are occurrences that are probably not likely, but they're certainly possible. So it's something that we want to be prepared for. And there's three or four areas that I'll just highlight here, not to scare anyone, but just to point out that, you know, maybe the market isn't factoring in these things, right? So the first and probably the most obvious one is terrorism. There could, you know, it's a dangerous world out there right now, and any act of terrorism between now and the elections certainly wouldn't be expected and could have an impact on our elections. There's a couple other areas, you know, Trump's taxes, all right? So it's all over the media right now. He's not releasing his taxes. It's getting a lot of commentary right now. What could change about that? Well, you know, the way if a hacker was able to get a hold of more tax documentation and something that the market wasn't aware of became publicized, that could have an impact on the election. On Clinton's side, the whole email issue. All right, so the WikiLeaks founder claims he has some more information regarding those emails. It's not public. He's threatening to make it public. Is there any truth to that? Who knows? I don't know. But I'm just saying that's something that could potentially impact the election, and it's certainly, there's no way to price that into the market right now other than to say, hey, uncertainty is a little bit higher than it normally would be, and that's a normal thing. Lastly, I'll highlight healthcare premiums. The Affordable Care Act, which has been implemented by President Obama and Secretary Clinton is a fan of and intending to continue. Well, very soon, healthcare premiums are set to be announced by the healthcare providers, and if those numbers come in different than expected, that could impact how the Americans view healthcare policy and the Affordable Care Act. So those are just four things that I think maybe are off the radar a little bit. Again, each of the four is probably unlikely for having any impact on the economy, but if you think about them, they're all possible, and they're all a reason to have a portfolio and to expect some volatility from time to time, to have the right allocation mix so that when something happens that's not expected, it doesn't force you to lose any sleep or get scared out of the markets. All right, and that leads us to really the conclusion. And I hope the main theme that I wanted to get across is that politics and investing don't generally go hand in hand. And I'd encourage you all, because this is certainly what we do, we focus on the fundamentals and not necessarily on politics and on elections. And we firmly believe, and we have a lot of data that shows it, that it's valuations, it's the health of corporations, it's earnings growth, it's interest rates, where we are in the economic cycle. These are the factors that have far greater influence on your portfolios than politics. And so that's the main theme of this presentation. The other theme is there's a big difference between the headline risk and what actually gets implemented, and Congress plays a big role in that, and our political system of checks and balances also plays a big role in that. The other thing, maybe a little bit more on the negative side, trees do not grow to the sky, so eventually the next recession will come. And it certainly doesn't seem like that's an imminent risk right now, but the idea that we could see a slowdown in the economy sometime during the next 4 years or the next term of our next president, well, that certainly seems like it's a possibility. So be sure that your investment portfolio is balanced, and that you have a very disciplined approach to that. And I think if you're a client of ours, I'm reasonably confident that that's been taken care of you already. And if you have an appropriate portfolio, it's far easier to stay invested and participate in the upside and always feel confident that no matter what the market brings, even if it's a downturn, a temporary downturn, there's not an urgent need to upend your plans or change course completely. And I think that's something that we do a fairly good job of, and that's trying to keep you focused on the long term and trying to keep emotion out of the financial decisions. And that's not easy in an election year. All right, it's very, very easy to become distracted, to get upset, to get emotional about all the information that's getting thrown our way, all the campaign promises and rhetoric and poll numbers that are hitting us from every angle, it seems, at this point in time. My main advice to all of you is to remain calm, focus on the fundamentals, have a plan, and stick to it. And with that, I think we will end it. Ben, did you want to say anything?
I just want to say thank you very much for your valuable insight, Steve. I hope this answers many of the questions our investors have regarding the election's effects on investing. It certainly should get us to focus on what's really important. I also want to thank everybody for tuning in today. This is going to conclude today's presentation. We ask that you please join us for our next webinar. Until then, we wish you good luck. Have a nice evening.
Thank you.